Before we begin, please remember that the information provided in this video is for educational and informational purposes only. It is not intended to be a substitute for professional financial advice. I am not a licensed financial advisor, and you should always consult with a qualified professional before making any significant financial decisions. Your personal financial situation is unique, and the strategies discussed here may not be suitable for your specific circumstances. That 0.5% difference on your mortgage rate, it could easily cost you over $35,000. Think about that. That's a brand new car, a down payment on an investment property, a college fund for your kid, and the most painful part? Millions of Americans are leaving that exact amount of money on the table, and they don't even realize it. They're giving it away to the bank as a completely unnecessary tip. You've probably done it. You spend a frantic weekend fueled by coffee, scrolling through a site like NerdWallet. You're plugging in numbers, comparing lenders, and you finally see it, a rate that makes you feel like you've won the lottery. It's beautiful. You can afford the house you really want. You get excited, you start picturing where the sofa will go, and you click apply. And then reality hits. A few days later, the loan officer calls back with your actual offer, and the rate is higher. Not by a lot, maybe just 1/4 or 0.5%. But you run the numbers again, and that sinking feeling hits you right in the gut. The monthly payment is higher. Your dream house just got a little bit further away. What happened? Did they lie to you? Was it a bait and switch? No. What you experienced is the single biggest misunderstanding in the home buying process. And in this video, I'm going to pull back the curtain and show you exactly what's going on so it never happens to you again. We are going to decode the mystery behind mortgage rates. By the time we're done, you won't just know how to read the rates on NerdWallet, you'll understand how to influence them in your favor. You'll know what the banks are looking for, what they're afraid of, and how to position yourself as the perfect low-risk applicant they are desperate to lend money to. This is the playbook to stop leaving money on the table and start keeping it in your pocket. So let's get right to it. The first thing you have to understand is that the rate you see advertised online, on any platform, is a best-case scenario rate. It's the rate for a perfect borrower. It assumes you have a stellar financial profile. Your job is to get your profile as close to that ideal as possible. And the single most important factor, the absolute king of the mortgage world, is your credit score. I know you've heard it a million times. Your credit score is important. But nobody ever really explains why in a way that makes sense. Think of your credit score as your financial report card for adulthood. It's a single 3-digit number that tells a lender the entire story of your financial reliability. It answers one simple question for them. If we lend this person hundreds of thousands of dollars, how likely are they to pay it back on time every single time for the next 30 years? It's all about risk. That's the entire game. The lower your perceived risk, the lower your interest rate. The higher your risk, the higher your rate. The bank is essentially charging you more for the stress you might cause them. So what do these numbers actually mean to a lender? Let's break it down into tiers. If your FICO score is 760 or above, congratulations. You are a financial rock star. In the eyes of a lender, you are the safest bet on the planet. You're a golden applicant. They aren't just willing to give you a loan. They will fight each other to give you their best possible rates because they know you're a sure thing. Now, what if you're in the 700 to 759 range? You're still in great shape. You're considered a very reliable borrower. You'll have access to excellent rates, maybe not the absolute rock bottom advertised rate, but very close to it. You are a solid, low-risk customer. When you dip into the 600s, things start to change. Let's say you're between 680 and 699. This is generally considered fair or average credit. You can still get a mortgage, absolutely. But the lenders are starting to see a little bit of risk. Maybe you have a late payment from a couple of years ago, or your credit card balances are a bit high. They're going to hedge their bets. They'll approve you, but they will charge you a slightly higher interest rate to compensate for that perceived risk. Once you fall below 680, and especially below 640, you enter a different category. Now you're considered a subprime borrower. This doesn't mean you're a bad person. It just means your credit history shows a pattern of higher risk. To a lender, this is a red flag. They will charge you a significantly higher interest rate to make the risk of lending to you worthwhile. And below 620, getting a conventional loan becomes extremely difficult, though not impossible. So, how much does this actually matter in the real world? Let's put some real dollars and cents to this. Imagine two people, Sarah and Mike. They both want to buy an identical house for $500,000. They have the same income, the same job, and the same 20% down payment. The only difference is their credit score. Sarah has been meticulous with her finances. She has an 805 credit score. She's a rock star. The bank offers her a fantastic rate, let's say 6.25%. Mike, on the other hand, has had a few bumps in the road. He missed a few payments a while back and his credit card debt is a little high. His score is a 650. He's in that fair but riskier category. The bank approves him, but they offer him a rate of 7.5%. Now, you might look at that and think, okay, 1.25% difference. That's not the end of the world. Oh, but it is. Let's do the math. Sarah's monthly principal and interest payment at 6.25% is about $2,462. Mike's monthly payment at 7.5% is about $2,796. That's a difference of $334 every single month. That's a car payment. That's your utility bills. That's a huge chunk of your grocery budget every month gone. But it gets so much worse. Let's zoom out and look at the life of the loan, all 30 years. Over those 30 years, Sarah will pay a total of about $486,000 in interest. Mike, for the exact same house, will pay a total of over $606,000 in interest. That is a staggering difference of $120,000. 120 grand. Poof. Gone. Handed directly to the bank, all because of that 3-digit number. Mike is paying for a whole luxury SUV that he will never get to drive. That is the raw, brutal power of your credit score. It is the foundation upon which your entire mortgage offer is built. It's not just a number. It's a direct reflection of how much your home will actually cost you. So, when you're looking at NerdWallet, and you see that amazing advertised rate, the very first question you need to ask yourself is my credit score in that top-tier 760 plus range? If it's not, you need to mentally adjust that advertised rate upwards because that's what the lender is going to do. But here's the good news. Your credit score isn't permanent. It's not tattooed on your forehead. It is a living, breathing number that you have the power to change. And understanding how it impacts your mortgage rate is the first step toward taking control. Now, your credit score might be the king, but it doesn't rule alone. There's another critical factor, a simple percentage, that can drastically alter your interest rate, even if you have perfect credit. It's a number that tells the bank how much of your own skin you have in the game, and it can be the difference between a good rate and a great one. This number is called your loan-to-value ratio, or LTV. And to understand why it's so powerful, you have to stop thinking like a homebuyer and start thinking like the bank. Imagine you're the lender. Two people walk into your office, both wanting a $400,000 loan for identical houses. Both have excellent 780 credit scores. Both have stable, high-paying jobs. On paper, they look like perfect candidates. The first person, let's call her Sarah, says, "I've saved up $20,000 for a down payment." That's 5%. You, the banker, do the math. You'd be lending her $380,000. She has $20,000 of her own money in the deal. Your stake is 19 times larger than hers. The second person, Tom, walks in. He says, "I've saved up $80,000 for a down payment." That's 20%. You'd be lending him $320,000. He has $80,000 of his own money tied up in this house. Your stake is now only 4 times larger than his. Who are you more comfortable lending to? Who do you think is less likely to walk away if times get tough? It's Tom, and it's not even close. This isn't about judging their character. It's about cold, hard risk assessment. Sarah's $20,000 down payment is a cushion, but it's a very thin one. If the housing market dips by just 6%, the house is now worth less than what she owes. She's underwater. Her entire down payment has been wiped out by a minor market fluctuation. If she loses her job or faces a financial emergency, the temptation to just mail the keys back to the bank and walk away from a bad investment becomes very, very real. She has less to lose. For the bank, this is a nightmare scenario. A foreclosure is a costly, time-consuming process that almost always results in a loss. So, to protect themselves from the higher risk Sarah represents, the bank does 2 things. First, they charge her a higher interest rate. It's a risk premium. They're essentially saying, "Okay, Sarah, we'll take this bigger gamble on you, but you're going to have to pay us more for the privilege." But the second thing they do is far more costly. They force her to buy an insurance policy. But here's the infuriating part. It's an insurance policy that she pays for, but it doesn't protect her at all. Protects the bank. It's called private mortgage insurance, or PMI. It's a monthly fee, tacked right onto her mortgage payment, that acts as a financial penalty for not having enough skin in the game. If she defaults on the loan, the PMI company pays the bank to cover some of their losses. So Sarah is literally paying a company every single month to insure her lender against her own potential failure. Now let's look at Tom. With his $80,000 down payment, he has a massive equity cushion from day one. If the market dips 6% or even 10%, he's not underwater. He's still got tens of thousands of dollars of his own money invested in that property. He is far, far less likely to default because he would be walking away from a huge pile of his own cash. He's not just a borrower. He's a partner in the investment. The bank sees this and they reward him. They give him a lower, more favorable interest rate. And, most importantly, he pays $0 in PMI. He's crossed the magic threshold. So what does this actually look like in dollars and cents? Let's run the numbers. Let's say the base interest rate is 6.75%. Because of her lower down payment, Sarah gets a rate of 7.25% on her $380,000 loan. Her monthly payment for principal and interest alone is about $2,600. But then you add the PMI, which could easily be another $150 a month. Her total payment is $2,750. Tom, with his 20% down, gets the better rate of 6.75% on his $320,000 loan. His monthly payment for principal and interest is about $2,075. No PMI. His total payment is $2,075. That's a staggering difference of $675 every single month. That's over $8,000 a year. But it gets so much worse when you look at the long term. Over the 30-year life of the loan, Sarah, with her perfect credit score, will pay over $150,000 more in total interest than Tom. $150,000. That's the price of not having enough skin in the game at the very beginning. It's a financial echo that reverberates for decades. And it's not just a simple switch that flips at 20%. Lenders view LTV in tiers. 97% LTV, or a 3% down payment, is seen as the highest risk. 95% is slightly better. 90% or 10% down is better still. Each time you cross one of these thresholds, you might unlock a slightly better rate or a lower PMI cost. The biggest leap, the one that changes the entire game, is hitting that 80% LTV mark, the 20% down payment that makes PMI disappear entirely. Think of it this way: your down payment is a signal. It's a powerful, nonverbal communication to the lender. It tells them a story about your financial discipline, your ability to save, and your commitment to this massive financial undertaking. A small down payment signals that you're stretching, that you might be financially fragile. A large down payment signals strength, stability, and seriousness. It tells the bank you're not a renter with a mortgage. You're an owner who is deeply invested in the success of the property. Now, is putting 20% down always the right or even possible answer? Of course not. In hyper-expensive markets in California or New York, a 20% down payment can be an astronomical, almost impossible sum of money for the average person. Saving that much could take a decade, during which time home prices might have risen so much that you're even further behind. There's also the concept of opportunity cost. Could that extra $60,000 that Tom put down have generated a better return if he had invested it in the stock market instead of tying it up in home equity? Maybe. This is why government-backed programs like FHA loans, which allow for down payments as low as 3.5%, or VA loans for veterans, which can require 0% down, exist. They are designed to open the door to homeownership for people who don't have a massive pile of cash sitting around. But it's crucial to understand that these programs are not a free lunch. They often come with their own form of mortgage insurance, different names but the same function, and sometimes it lasts for the entire life of the loan. The fundamental principle never changes. The less skin you have in the game, the more you will pay for the privilege of borrowing. The bank will always get paid for the risk it's taking, so your down payment sets the stage. It's the opening act of your mortgage story, establishing the fundamental level of risk the lender sees in you. It dictates the foundation of your interest rate and your monthly costs. But your down payment is only half of the risk equation. You've shown the bank how much of your own money is on the line. But what about the risk of the money they're lending you? The type of loan you choose, the very structure of the deal, can be a safe, predictable vessel or a ticking time bomb. There's a hidden battle between stability and risk baked into your mortgage contract. A choice between a fixed, unchanging path, and a volatile one that could either save you a fortune or cost you your home. And most people pick a side without ever truly understanding the rules of the game. So let's play the game. There are 2 doors in front of you. Behind door number 1 is a path that is straight, paved, and predictable. The incline is set from day 1, and it will never change. It might feel a little steeper at the start, but you know with absolute certainty where it ends. Behind door number 2 is a different kind of path. It starts with a gentle, inviting downhill slope. Feels effortless, almost too good to be true. But just over the horizon, that path could turn into a treacherous mountain climb with no warning. This is the choice between a fixed-rate mortgage and an adjustable-rate mortgage, or ARM. And the door you choose will define your financial life for decades. Let's start with door number 1, the fixed-rate mortgage. This is the bedrock of the American housing market. It's the option over 90% of homebuyers choose, and for good reason. It is the very definition of stability. When you get a 30-year fixed-rate mortgage at, say, 7%, you are making a pact with the lender. You are locking in that 7% for the entire 360-month life of the loan. It doesn't matter if the economy booms and interest rates for new loans skyrocket to 18% like they did in the 1980s. It doesn't matter if there's a recession, a war, or if the Federal Reserve starts having meetings on the moon. Your rate is 7%. Period. This means your principal and interest payment will be the exact same number on your first month as it will be on your last month 30 years from now. The only thing that might change your total monthly payment is property taxes or homeowner's insurance, but the core of your loan, the part you're paying to the bank, is set in stone. This predictability is more than just a financial convenience. It's a psychological anchor. It allows you to budget with confidence. You can plan your life, your savings, your investments, knowing that your biggest monthly expense is a known quantity. For people who crave security, who want their home to be a sanctuary from the chaos of the world, the fixed-rate mortgage is the only choice. It's the sleep well at night loan. The trade-off? You often pay a slightly higher initial interest rate for this peace of mind. The bank is taking on all the risk of future rate increases, and they charge a premium for that insurance policy. You're paying for certainty. Now let's talk about door number 2, the adjustable rate mortgage, the ARM. This is the path that starts downhill. When you look at rates on NerdWallet, the ARM will almost always have a lower, more seductive number next to it. You might see a fixed rate at 7%, but a 5-to-1 ARM is being offered at 5.5%. On a $400,000 loan, that's a difference of nearly $400 a month at the start. That's a car payment. That's a vacation fund. That's a serious chunk of change. And this is the trap. Or, for the savvy and the strategic, the opportunity. An ARM is really 2 loans in one. It has an initial fixed rate period, followed by a much longer adjustable period. That's what the numbers in 5-to-1 ARM mean. The 5 means your rate is fixed for the first 5 years. The 1 means that after those 5 years are up, your rate can change once every 1 year for the rest of the loan's term. You might also see 7-1 ARMs or 10-1 ARMs, same concept, just a longer initial fixed period. For those first 5, 7, or 10 years, you get the benefit of that lower teaser rate. You're saving money every single month compared to the person who took the fixed-rate loan. But what happens when that fixed period ends? That's when the game changes. Your rate is no longer fixed. It becomes tied to a benchmark financial index, something like the SOFR, which is basically a reflection of what it costs banks to borrow money from each other. Your lender then adds their own chunk on top of that, called the margin. The index plus the margin equals your new interest rate. If the index has gone up since you first got your loan, your rate goes up. And so does your monthly payment. And it can continue to go up every single year after that. Let's make this real. Imagine 2 neighbors, Sarah and Rob, who buy identical houses at the same time. Sarah's cautious. She takes a 30-year fixed-rate mortgage at 7%. Her principal and interest payment is locked in at about $2,660 a month. She sleeps like a baby. Rob sees himself as a financial shark. He scoffs at the 7% rate. He takes a 5-to-1 ARM with a teaser rate of 5.5%. His payment is only $2,270 a month. He's saving nearly $400 a month. For the first 5 years, he feels like a king. He tells Sarah she's throwing money away. He uses his savings to lease a luxury car. He feels brilliant. Then year 6 arrives. During those 5 years, the economy has been on a tear, and the Federal Reserve has raised interest rates to combat inflation. The index his loan is tied to has shot up by 3 percentage points. So his interest rate adjusts from 5.5% to 8.5%. His monthly payment explodes from $2,270 to over $3,075. It's suddenly $400 more than Sarah's. The luxury car now feels like a lead weight around his neck. The next year, rates go up again. And again. Rob is now trapped. His housing cost is unpredictable and crushing, and the equity in his home is being eaten alive by interest. He's not sleeping so well anymore. This is the nightmare scenario that gave ARMs their toxic reputation, especially after the 2008 housing crisis, where millions of people with ARMs saw their payments skyrocket to unaffordable levels, leading to a tidal wave of foreclosures. So are ARMs just a sucker's bet? A financial landmine to be avoided at all costs? Not necessarily. For the right person in the right situation, the ARM can be a powerful and intelligent tool. It's not about being a gambler. It's about having a strategy. When does an ARM make sense? There are three main scenarios. First, if you know with near certainty that you will sell the house before the fixed-rate period expires. Let's say you're in the military and have orders to relocate in 4 years. Why pay the higher premium for a 30-year fixed rate? Taking a 5-to-1 or 7-to-1 ARM allows you to enjoy the lower payment for the entire time you own the home, and you sell it long before the risk of adjustment ever kicks in. You get all of the upside and none of the downside. Second, if you confidently expect your income to increase substantially in the near future. Maybe you're a medical resident or a junior lawyer at a big firm. You know your salary is going to double or triple in a few years. You can take the ARM to have a lower, more manageable payment now when your income is lower, with the full confidence that you'll be able to easily absorb any potential payment increases down the road. And third, the riskiest strategy of all. You're betting that interest rates will go down. If you buy a home when rates are at a historical peak, you might take an ARM with the belief that by the time it adjusts in 5 or 7 years, rates will have fallen, and your payment will actually go down. It's a gamble on the direction of the entire US economy, but for some sophisticated borrowers, it can pay off handsomely. When you're on NerdWallet, you're not just looking at a list of numbers. You're looking at two fundamentally different philosophies for owning a home. One is a promise of stability. The other is a calculated risk. The site will show you both options, but it can't make the choice for you. It can't know if you're planning to move in 3 years or stay for 30. It can't know if your income is about to jump, or if you value a predictable budget above all else. You have to decide which door to walk through. Are you steady Sarah? Or are you a strategic Rob with a solid exit plan? Once you've made that choice, once you've picked your weapon, the steady fixed-rate longsword or the volatile but initially powerful ARM, the decisions are still not over. Because now you have to decide on the length of the campaign. Are you prepared for a grueling 30-year war of attrition against your debt, making smaller payments over a vast stretch of time? Or do you have the resources for a swift, brutal 15-year blitz, a frontal assault that will cost you more each month but will win you your freedom, and a fortune in saved interest in half the time? This next choice, the loan term, is just as critical, and it's where we're going next. The 30-year fixed-rate mortgage. It's the bedrock of the American dream, the default setting for homeownership in the United States. It's the long, winding, scenic route to owning your home. The payments are lower, more manageable, designed to fit comfortably within a monthly budget. It gives you breathing room. It allows you to buy more house, to afford the neighborhood you want, to still have money left over for car payments, for vacations, for life. For 3 decades, you have a predictable, stable housing cost. In a world of financial chaos, it is an anchor of certainty. The bank loves it because it guarantees them a steady stream of interest payments for 30 years. You love it because it makes the impossibly expensive dream of a home possible. It's the marathon. Slow, steady, and you'll eventually cross the finish line. Then there's the 15-year fixed-rate mortgage. This is not the scenic route. This is the direct, steep, brutal assault on the mountain. It is a declaration of war on your debt. The monthly payments are significantly higher. They will bite. They will force you to be disciplined, to cut back, to say no to frivolous spending. For 15 years, your budget will be tighter, your financial flexibility will be reduced. You will feel the strain. But the reward is breathtaking. You build equity at a staggering rate. While your neighbor on the 30-year plan is still chipping away at interest, you are carving out massive chunks of principal. You are gaining ownership, real ownership, of your asset with every single payment. And the ultimate prize? Freedom. In half the time, the war is over. The house is yours. The single largest expense in your life vanishes, just as your kids might be heading to college or you're thinking about early retirement. You've won. Let's stop talking in metaphors and start talking in dollars. Because the numbers are what will change your entire perspective on this decision. Let's imagine a $400,000 loan, a pretty standard amount in many parts of the country today. And let's say, after shopping on NerdWallet, you find a great rate of 6.5%. If you choose the 30-year marathon, your monthly principal and interest payment will be about $2,528. That feels manageable. You can budget for that. Over 360 payments, you will pay the bank back their $400,000. But you will also pay them an additional $510,218 in interest. Let me repeat that. You borrowed $400,000 and you paid back over $900,000. More than half of the money you spent went directly to the bank as pure profit, a fee for borrowing their money over a long period. That is the hidden cost of the scenic route. Now let's look at the 15-year blitz. Using that same $400,000 loan, we'll even use the same 6.5% interest rate, though in reality, 15-year loans often have slightly lower rates because they're less risky for the lender. Your monthly payment for the 15-year term would be about $3,480. That's nearly $1,000 more per month. It's a huge jump. It's a serious commitment. Many people would look at that number and immediately say, "No way. I can't afford that." But hold on. Let's look at the total cost. Over 180 payments, you pay back the $400,000. But the total interest you pay is $226,357. Let's put those two numbers side by side. With the 30-year loan, you paid over $500,000 in interest. With the 15-year loan, you paid just over $226,000. That is a difference of $283,861. $283,861. That is a brand new Ferrari. That is a down payment on 3 other investment properties. That is your kid's entire college education paid in full. That is a secure, comfortable retirement. It is a life-changing amount of money that you are voluntarily handing over to the bank, simply for the comfort of a lower monthly payment for a longer period of time. When you see it laid out like that, it's not just a financial choice. It's a profound life choice. Are you willing to trade nearly $300,000 of your future wealth for about $1,000 of monthly cash flow today? There is no single right answer. For some, the 30-year is the only way. If you have a variable income, if you're just starting your career, if you want to use your extra cash flow to invest in the stock market where you believe you can get a higher return than your mortgage rate, the 30-year provides crucial flexibility. It's a safety net. A higher monthly payment on a 15-year loan could put you one bad month, one job loss, one medical emergency away from foreclosure. The lower payment of the 30-year gives you a buffer against the chaos of life. But for those with stable, high incomes who are disciplined and prioritize debt freedom above all else, the 15-year is a powerful wealth-building tool. The forced savings mechanism of the higher payment builds your net worth relentlessly. And the psychological benefit of being completely debt-free in your 40s or 50s is something you can't put a price on. Now, here's a secret strategy that many savvy homeowners use to get the best of both worlds. They take out a 30-year fixed-rate mortgage to lock in that low, required minimum payment. This is their safety net. But they use a 15-year amortization calculator to figure out what the payment would be for a 15-year loan, and they pay that higher amount every single month. If a tough month comes along, a car repair, a job furlough, they can fall back to the lower, required 30-year payment without any penalty. But in all the good months, they are attacking the principal, paying it down on a 15-year schedule, and saving themselves hundreds of thousands of dollars in interest. They have the flexibility of the 30-year with the financial power of the 15-year. When you're on NerdWallet comparing options, you will see this factor play out in real time. You'll toggle between the 30-year and 15-year terms, and you'll see the rates and monthly payments change instantly. And you'll notice something critical. Lenders almost always offer a lower interest rate for a 15-year loan. Why? Because it's less risky for them. The faster you pay back the principal, the less time there is for you to default, and the less time their money is exposed to the risks of inflation and market changes. So not only are you paying for a shorter period, you're often paying at a better rate. This pours gasoline on your savings, making the total interest difference even more gigantic. So you've made your choice. You've weighed the marathon against the sprint. You've decided on your timeline for financial freedom. You've chosen the path. But what if the path itself could change? What if the interest rate you locked in wasn't really locked in at all? We've only been talking about fixed-rate loans, where the rules are set in stone from day one. But there is a whole other universe of mortgages out there. A world of adjustable rates, of introductory offers, of rates that can rise and fall with the markets. turning a safe, predictable payment into a monthly gamble. This is the world of loan types. It's where some people get an incredible deal, and others get into a world of trouble. And that choice between a fixed rate and an adjustable one is the next critical factor we need to dissect. Let's pull back the curtain on this choice. On one side, you have the fortress of stability, the fixed-rate mortgage. On the other, the siren song of a lower initial payment, the adjustable-rate mortgage or ARM. This isn't just a financial decision. It's a decision about what kind of future you're willing to bet on. Think of it like choosing a path for a 30-year hike. The fixed-rate mortgage is the paved, well-lit, and perfectly flat trail. You know the exact incline, the exact distance, and you know that every single step will be just like the last. The interest rate you lock in on day one is the interest rate you will pay on day 10,950. It doesn't matter if the economy outside is experiencing a beautiful sunny day or a Category 5 hurricane. Your path, your payment remains unchanged. This is the ultimate sleep well at night option. Your principal and interest payment is a constant, a bedrock of your monthly budget. If you get a 30-year fixed-rate mortgage at 6.5%, your payment in year 29 will be calculated on that same 6.5%, even if the going rate for new mortgages has soared to 15%. This predictability is its superpower. You can plan your entire financial life around this one unwavering number. Now, why wouldn't everyone choose this path? Because the ticket to enter this paved, secure trail often comes at a higher price, at least at the start. Lenders are taking on all the risk of future interest rate hikes, and they charge you a premium for that protection. So, the initial interest rate on a 30-year fixed loan is almost always higher than the introductory rate on an adjustable rate loan. You're paying for peace of mind. Let's meet our first homebuyer. Safe bet Sarah. Sarah is a planner. She and her partner want to buy a home, put down roots, and raise their kids there. They see this house as their forever home. The idea of their mortgage payment suddenly jumping by hundreds of dollars a few years down the line is terrifying. It would throw their carefully crafted family budget into chaos. For Sarah, the slightly higher initial payment of a fixed-rate mortgage is a small price to pay for 3 decades of absolute certainty. She looks at the rates on NerdWallet, sorts by 30-year fixed, and focuses only on those options. She's buying stability. Now let's walk down the other path, the one that looks like a shortcut through a beautiful sun-dappled forest. This is the adjustable-rate mortgage. The entrance to this path is incredibly tempting. It's marked with a sign that shows a much lower interest rate than the paved trail. This is the ARM's teaser rate, or introductory rate. An ARM is a hybrid. It starts out like a fixed-rate loan for a set period, commonly 3, 5, 7, or 10 years. During this time, your rate is locked and low. This is the 5 in a 5-to-1 ARM, or the 7 in a 7-to-1 ARM. It means you get 5 or 7 years of a fixed, low payment. This is the sun-dappled part of the trail. For these initial years, you're paying less each month than Sarah is, potentially saving hundreds of dollars. You might even be able to afford a larger home because of this lower initial payment. But after that introductory period ends, the path changes. The 1 in a 5-to-1 ARM means that after the first 5 years, your interest rate will adjust once every 1 year. The trail is no longer paved. It now follows the terrain of the wider economy. Your new interest rate is calculated by taking a market index, like the Secured Overnight Financing Rate, or SOFR, and adding a number called the margin, which is set by your lender. If that index has gone up, your rate goes up. If it goes down, your rate goes down. Your monthly payment is now tied to the whims of the market. This is where the fear kicks in. What if rates skyrocket? This is the legitimate risk that led to so much disaster in the 2008 financial crisis. But modern ARMs have safety features or guardrails called caps. There are usually 3. First, there's an initial adjustment cap. This limits how much the rate can jump the very first time it adjusts. It prevents a massive sudden shock. Second, there's a periodic cap, which limits how much the rate can go up or down in any subsequent adjustment period. For example, no more than 2 percentage points per year. Finally, and most importantly, there's a lifetime cap. This is the absolute ceiling your interest rate can never ever exceed, no matter how crazy the market gets. If your lifetime cap is 5% above your starting rate of 4%, you know your rate will never go above 9%. It's a worst-case scenario you can plan for. So who in their right mind takes this risk? Let's meet our second homebuyer, risk-taker Rob. Rob is a surgical resident. He knows for a fact that in 4 years his residency will be over, and he'll be moving to a different city for a fellowship or a new job. He has no intention of being in this house for more than 4 years. Rob looks at a 5-to-1 ARM. He sees that the introductory rate is a full percentage point lower than the 30-year fixed rate. For him, this isn't a 30-year gamble. It's a 4-year sure thing. He can take advantage of the significantly lower monthly payments for the entire time he plans to live in the house, and then sell the property long before the first rate adjustment ever happens. He'll save thousands of dollars in interest, which he can use to pay down his student loans or build his savings. For Rob, the ARM isn't a risk. It's a perfectly logical, strategic tool. The choice between fixed and adjustable fundamentally changes how you interpret the rates you see on NerdWallet. When you scroll through that list of lenders, you might see an eye-poppingly low rate of 5.25% next to a more common rate of 6.75%. Your first instinct is to jump on the lower one, but now you know to look closer. That 5.25% is likely the teaser rate on a 5-to-1 or 7-to-1 ARM. The 6.75% is the rate for a 30-year fixed. Which one is better depends entirely on whether you're a Sarah or a Rob. It depends on your timeline, your risk tolerance, and your life plan. There is no universally correct answer. Choosing a fixed-rate mortgage in a falling-rate environment means you could be stuck overpaying unless you refinance, which costs money. Choosing an ARM in a rising-rate environment could lead to significant payment shock if you stay in the home past the initial fixed period. Your personal story dictates the right loan type for you. Are you building a fortress for the next 30 years? Or are you setting up a temporary camp for the next 5? Your answer to that question is one of the most powerful factors in determining which NerdWallet mortgage rate is actually the best deal for you. It's about aligning the financial product with the reality of your life. But this decision between a fixed or floating rate is only one dimension of the choice. There's another, equally critical variable that runs parallel to it: the loan term. The difference between stretching your payments out over 30 years versus compressing them into 15. This choice dramatically alters not just your monthly payment, but the total 6-figure sum of interest you'll hand over to the bank. It's the difference between freedom and debt, and it's the next piece of the puzzle we have to solve. So let's dissect this monumental choice. On one side, you have the 30-year fixed-rate mortgage. It's the American default. It's the comfortable, familiar option that lenders will push, that your parents probably had, and that nearly 90% of homebuyers choose. Its primary appeal is seductive in its simplicity: a lower monthly payment. It spreads the massive cost of a home over 360 individual payments, making the seemingly unaffordable affordable. It gives you breathing room. It means more cash in your pocket each month for groceries, for car payments, for life. Feels safe. On the other side, you have the 15-year fixed-rate mortgage. It's the sprinter to the 30 years marathon runner. It's intense. The monthly payments are significantly higher, demanding a larger chunk of your income and a stricter budget. It feels restrictive, maybe even a little scary. It asks for sacrifice today in exchange for a promise tomorrow. And this is the exact point where millions of Americans make a decision that costs them a fortune. They choose the illusion of safety over the mathematical certainty of wealth creation. Let's stop talking in hypotheticals and use real numbers, because this is where the comfortable fantasy of the 30-year mortgage shatters against the cold, hard reality of amortization. Imagine you're buying a home and need a mortgage for $400,000. You check NerdWallet and see the rates. For a 30-year fixed loan, the rate is, let's say, 6.5%. For a 15-year fixed loan, because it's less risky for the bank, they offer you a slightly better rate, let's call it 6%. This is very common. Shorter loans often get preferential rates. Let's run the numbers on the 30-year loan first. At 6.5%, your monthly principal and interest payment on that $400,000 loan is about $2,528. Manageable for many households. Fits the budget. Now let's look at the 15-year option. At 6%, your monthly payment shoots up to $3,375. That's an extra $847 a month. That's a car payment. That's a student loan payment. That's a serious chunk of change. And it's the reason most people immediately back away and sign up for the 30-year term without a second thought. But they're only looking at one half of the equation. They're only seeing the monthly cost. They are completely blind to the total cost. So let's finish the math. For that 30-year loan, you'll make that $2,528 payment every month for 360 months. When you make your final payment 30 years from now, how much will you have paid the bank in total? You will have paid a staggering $910,000 for a $400,000 loan. That means you paid the bank $510,000 in interest alone. You bought your home and then you bought the bank a Lamborghini. You paid more in interest than you did for the actual house. Now let's look at the 15-year loan. The payment was higher, yes. It was a sacrifice. But you only make that payment for 180 months, not 360. At the end of those 15 years, you will have paid a total of $607,500. The total interest you paid the bank? $207,500. Let that sink in. By choosing the 15-year mortgage by committing to that higher payment, you save $302,500. $300,000. That is not a typo. That is life-changing money. That is college for your kids paid in cash. That is a massively boosted retirement account. That is the freedom to start your own business or travel the world. And what's more, you are completely debt-free 15 years sooner. While the person with the 30-year mortgage is still grinding away, sending thousands of dollars to the bank every month, you own your home outright. The money you were sending to the bank for your mortgage can now be funneled directly into investments, compounding and building your wealth at an explosive rate. The choice isn't really between a lower payment and a higher payment. It's a choice between paying for one house or paying for two. It's a choice between working for yourself or working for the bank for an extra 15 years. Now I can hear some of you saying, "That's great, but I literally cannot afford that extra $850 a month. It's just not possible." And that is a completely valid and responsible position. Forcing yourself into a 15-year payment that you can't sustain is a recipe for disaster. But this is where we introduce a third, more strategic option. The hybrid approach. Here's the strategy. You take out the 30-year fixed-rate mortgage to get the safety and flexibility of that lower required payment. But you commit to paying it as if it were a 15-year loan. You use a mortgage calculator on NerdWallet, figure out what the 15-year payment would be, and you voluntarily pay that higher amount every single month. Every extra dollar you pay goes directly towards your principal balance, not interest. This has a powerful effect. It accelerates your loan payoff, you still save a massive amount in interest, and you build equity far more quickly. The beauty of this strategy is its flexibility. If you have a great month, you make the larger payment. If you have a terrible month, say the water heater breaks or you have an unexpected medical bill, you have the legal right to fall back to the lower, required 30-year payment without any penalty or damage to your credit. You have a built-in emergency brake. You get the peace of mind of the 30-year term with most of the wealth-building power of the 15-year. What's the catch? There is one small one. Remember how the 15-year loan often comes with a slightly lower interest rate? With this hybrid strategy, you're stuck with the slightly higher 30-year rate. So, over the life of the loan, you will pay a little more in total interest than someone with a true 15-year mortgage, but you will still save hundreds of thousands compared to someone just making the minimum 30-year payment. It is an infinitely better option than sleepwalking through a 3-decade loan. This decision, 15-30 or the hybrid approach, is one of the most impactful financial choices you will ever make. It dictates the pace of your wealth creation for decades. It's not just a line item on a mortgage application. It's a declaration of your financial priorities. Do you prioritize short-term cash flow or long-term freedom? And this is precisely why the tools on a site like NerdWallet are so crucial. They don't just show you a rate. They allow you to model these scenarios. You can plug in your loan amount and instantly see the dramatic difference in monthly payment and, more importantly, total interest paid between a 15-year and a 30-year term. You can see, in stark black and white, the staggering cost of convenience. It transforms an abstract concept into a concrete, 5- or 6-figure number that is impossible to ignore. You've now wrestled with your credit, your down payment, and the very timeline of your debt. You've chosen your path. But there's another fundamental characteristic of the loan itself we have to define. Another fork in the road. It's a choice between stability and risk. A choice between a rate that's locked in stone versus a rate that floats on the unpredictable seas of the global economy. We're talking about the difference between a fixed-rate mortgage and an adjustable-rate mortgage, and understanding this distinction is absolutely critical to protecting yourself from financial ruin. So let's break it down. Imagine you're setting sail on a 30-year voyage, which is what a mortgage really is. You have two choices for your vessel. The first is a massive, steady, unsinkable ocean liner. This is your fixed-rate mortgage. The second is a sleek, fast, and nimble speedboat. This is your adjustable-rate mortgage, or ARM. Both can get you to your destination, but the journey will be vastly, and I mean vastly, different. Let's start with the ocean liner. The fixed-rate mortgage. Its name tells you everything you need to know. The interest rate is fixed. It's locked in. For the entire duration of your loan, whether it's 15 years or 30 years, that rate will not change. Not by a fraction of a percent. Not ever. If you lock in a rate of 6.5%, you will be paying 6.5% on your final payment 3 decades from now, even if the world outside has gone completely haywire and new mortgage rates are at 15%. This creates a powerful sense of stability. Your monthly payment for principal and interest is a constant, unchanging number. It's the bedrock of your financial planning. You can budget around it with absolute certainty. You know exactly what it will be next month, next year, and 10 years from now. It's predictable. It's safe. It's boring in the best possible way. When financial storms are raging, the fixed-rate mortgage is your fortress. The waves of economic uncertainty can crash against the hull, but inside you don't feel a thing. The downside? Well, that stability comes at a price. The interest rate on a fixed-rate mortgage is often slightly higher, right from the start, than the initial rate offered on an adjustable-rate mortgage. You're paying a small premium for 30 years of guaranteed peace of mind. And if interest rates plummet a few years into your loan, you're stuck with your higher rate unless you go through the hassle and expense of refinancing. Now let's talk about the speedboat, the adjustable-rate mortgage. This is where things get exciting and potentially terrifying. An ARM is designed to lure you in with what's called a teaser rate or an introductory rate. This rate is fixed for an initial period, typically 3, 5, 7, or 10 years. And this introductory rate is almost always lower, sometimes significantly lower, than the rate for a 30-year fixed loan. So let's say you see a 5-to-1 ARM. What does that mean? The 5 means your introductory interest rate is fixed for the first 5 years. It's 5 years of smooth sailing on calm, predictable waters. Your payments are low, you feel like a genius, and you're saving a ton of money compared to your friend who took out that boring fixed-rate loan. The 1 means that after those first 5 years are up, your interest rate will adjust once every 1 year for the rest of the loan's term. And here is the billion-dollar question. What does it adjust to? Your rate isn't just pulled out of thin air. It's calculated using a formula. It's tied to a specific financial benchmark, an index. Think of this index as the wind speed on the open ocean. A common one these days is the SOFR, or the Secured Overnight Financing Rate. When that index goes up, your interest rate goes up. When it goes down, your rate goes down. The lender then adds their own piece to it, a number called the margin. The margin is their guaranteed profit. It's a fixed percentage that gets added to the index value. The index can change, but the margin never does. So, your new rate is simply the index plus the margin. This sounds incredibly risky, right? Your financial fate is tied to a number you can't control. And it is. This is the exact mechanism that caused so much devastation in the 2008 financial crisis. People were lured in by impossibly low teaser rates, not fully understanding that when their rates adjusted, their monthly payments would explode, becoming completely unaffordable. To prevent a total repeat of that disaster, modern ARMs have safety features. They're called caps. Think of them as the life preservers on your speedboat. There are usually 3 of them. First, there's the initial adjustment cap. This limits how much your rate can jump the very first time it adjusts after your introductory period ends. Second is the periodic adjustment cap, which limits how much the rate can go up or down in any subsequent adjustment period. For example, no more than 2% per year. And finally, and most importantly, there's the lifetime cap. This is the absolute ceiling your interest rate can never ever exceed, no matter how chaotic the economy gets. So let's paint a picture. Meet 2 families, the Thompsons and the Garcias. They buy identical houses side by side for $400,000. It's a competitive market, and interest rates are sitting around 7%. The Thompsons are cautious. They go for the 30-year fixed-rate mortgage at 7%. Their principal and interest payment is locked in at about $2,660 a month. It's a stretch, but they know they can handle it. The Garcias are a bit more adventurous. Their lender offers them a 5-to-1 ARM with a stunningly low introductory rate of just 5%. Their monthly payment is only $2,147. They are saving over $500 a month compared to the Thompsons. They feel brilliant. For 5 years, they live it up. That extra $500 a month goes towards a new car, nicer vacations, and dinners out. They look at the Thompsons and feel a little sorry for them, stuck with that high old-fashioned payment. Then year 6 arrives. The Garcias get a letter in the mail. It's from their mortgage company. Their 5-year introductory period is over. The economy has changed. The Federal Reserve has been raising rates to fight inflation. The index their loan is tied to has shot up. Their interest rate isn't 5% anymore. Thanks to the caps, it doesn't go to 10% overnight, but it does adjust upward by the maximum 2% allowed. Their new rate is 7%. Suddenly, their monthly payment is the same as the Thompsons. That $500 monthly advantage has vanished. The speedboat has hit some choppy water. But it gets worse. In year 7, rates go up again. Their rate adjusts from 7% to 9%. Now their monthly payment is over $3,200 a month. It's now more than $500 higher than the Thompsons' payment, which of course hasn't changed by a single penny. The Garcias are in a panic. The vacations stop. The car payment feels like an anchor. They are now house poor, with a massive portion of their income being devoured by a mortgage payment that feels like a runaway train. The Thompsons, meanwhile, are sleeping soundly. Their financial ocean liner steams ahead, completely unbothered by the hurricane raging outside. This story illustrates the profound, life-altering difference between these two loan structures. The fixed rate offers certainty. The ARM offers a short-term benefit in exchange for long-term risk. So why would anyone in their right mind choose the speedboat? Well, an ARM can be a powerful and intelligent tool, if used correctly by the right person. Who is that person? It's someone who knows with a high degree of certainty that they won't be in the house when the rate starts adjusting. If you're in the military and know you're being relocated in 4 years, taking a 5-to-1 ARM makes perfect sense. You get the benefit of the lower payment for your entire stay. And sell the house long before the risk of adjustment ever kicks in. Or perhaps you're a medical resident. You have a low income now, but you know that in 6 years your income will triple. You might take a 7-to-1 ARM to have lower payments during your lean years, confident you can easily afford much higher payments by the time the rate adjusts. It's a calculated risk based on a predictable life event. The danger is for people who take an ARM simply because the payment is lower, with a vague hope that they'll be able to refinance, or that rates will go down before it adjusts. Hope is not a financial strategy. When you're looking at NerdWallet, you'll see these loan types listed side by side. It's incredibly tempting to just sort by the lowest interest rate and see those juicy ARM numbers at the top. But you have to look deeper. NerdWallet gives you the tools to see the whole picture. The loan type, the term, the APR, which accounts for fees, but it's on you to understand the fundamental risk you're taking on. Choosing an ARM isn't just a financial decision. It's a bet on the future of the economy and your own personal circumstances. Now that you understand the fundamental architecture of the loans themselves, the steady ocean liner versus the risky speedboat, we need to add another layer of complexity. Because the rate you're offered isn't just about the loan type or the global economy. It's deeply personal. Lenders are looking at you. And one of the biggest factors they scrutinize is how much of your own skin you have in the game. We're talking about your down payment, the concept of loan-to-value, and the dreaded acronym that can cost you thousands of dollars a year, PMI. Understanding this is the next critical piece of the puzzle. Let's start with the down payment because from a lender's perspective, this is the ultimate sign of commitment. It's your initial investment, your stake in the property. Think of it like this. If you're a lender about to hand someone hundreds of thousands of dollars, who would you feel more comfortable lending to? The person who puts down 3% or the person who puts down 20%? The answer is obvious. A larger down payment signals two incredibly important things to a lender. First, it shows financial discipline. You've managed to save a significant chunk of cash, which suggests you're responsible with money and less likely to miss your future mortgage payments. Second, and this is the big one, it reduces the lender's risk. Immediately, if you put down 20% on a $500,000 home, you've just paid $100,000 out of your own pocket. The bank is only on the hook for $400,000. If, for some catastrophic reason, you default on the loan early on and the bank has to foreclose, they have a massive $100,000 equity cushion. They can sell the house, even at a slight discount, and still be confident they'll get their money back. You, on the other hand, have $100,000 of your own money to lose. You have serious skin in the game. You are going to fight tooth and nail to make those payments. Now flip that. Imagine you only put down 3.5%, which is $17,500 on that same home. The bank is now on the hook for over $480,000. If you default, that small equity cushion can be wiped out in an instant by foreclosure costs and a dip in the market. The lender's risk is exponentially higher. And how do lenders compensate for higher risk? You already know the answer, they charge you a higher interest rate. So when you're on NerdWallet and you toggle that down payment slider, you're not just changing a number on a screen. You are actively changing your risk profile in the eyes of every single lender on that platform. Sliding it from 5% to 10% might shave 1/8 of a point off your rate. Sliding it to 20% could be the difference between a good rate and a great rate. Over 30 years, that small fraction of a percent translates into tens of thousands of dollars in saved interest. This brings us directly to the technical term for this concept: loan-to-value, or LTV. It's exactly what it sounds like. The ratio of the loan amount to the appraised value of the home. It's just the other side of the down payment coin. If you put 20% down, your LTV is 80%. If you put 5% down, your LTV is 95%. Lenders live and breathe LTV. It's a core metric for assessing risk. And there is a magic number in the world of mortgages, a golden threshold for LTV: 80%. Once your loan-to-value ratio is at 80% or lower, meaning you have at least 20% equity, the entire game changes. You unlock the best rates, the smoothest approvals, and you avoid the single most hated expense in home buying: private mortgage insurance. PMI. 3 letters that can strike fear into the heart of a homebuyer. Let's demystify this, because understanding it is key to avoiding or eliminating it. First, a common misconception: private mortgage insurance does not protect you at all. It protects the lender. When your LTV is higher than 80%, meaning you've put down less than 20%, the lender sees you as a higher risk. So, they force you to pay for an insurance policy. This policy pays out to the lender if you default on your loan, and the foreclosure sale doesn't cover their losses. You are literally paying a monthly premium for an insurance policy that benefits your bank. It's a financial penalty for not having enough skin in the game. And it is not cheap. PMI is typically calculated as a percentage of your total loan amount, ranging from about 0.5% to over 1.5% per year, depending on your credit score and LTV. Let's put that into real numbers. Say you buy a $400,000 house with 10% down, or $40,000. Your loan is $360,000, and your LTV is 90%. The lender will almost certainly require PMI. If your PMI rate is 0.8%, you would calculate it like this: $360,000 times 0.008, which equals $2,880 per year. Divide that by 12, and you are paying an extra $240 every single month on top of your principal, interest, taxes, and homeowner's insurance. That's $240 that builds you zero equity. It does nothing to pay down your loan. It's like setting money on fire every month just to reassure your lender. Over 5 years, that's over $14,000 gone. This is why putting down 20% is considered the gold standard. It allows you to sidestep this expensive trap from day one. When you use NerdWallet's mortgage calculator, it's crucial that you check the box that includes PMI if you know you're putting down less than 20%. Don't just look at the principal and interest. You need to see the full picture of your monthly payment, and PMI can be a shockingly large part of it. The rates NerdWallet shows you from lenders are one thing, but the all-in cost of your housing is another, and PMI can blow up your budget if you're not prepared for it. But what if you can't save up a full 20% down payment? For many people, especially in high cost of living areas, saving $100,000 or more is simply not realistic. Does that mean you're doomed to pay PMI forever? Absolutely not. And this is where you can be strategic. You need to know the escape plan. Federal law, specifically the Homeowners Protection Act, gives you rights. First, you can request to have your PMI canceled once your loan balance is scheduled to reach 80% of the original home value. But here's a pro tip. That can take years. A faster way is if your home's value increases. Let's go back to that $400,000 house where you put 10% down. Your loan was $360,000. 2 or 3 years go by, the market is hot, and your home is now appraised at $450,000. Your loan balance might have only been paid down to, say, $350,000, but your LTV is now calculated against the new value. $350,000 divided by $450,000 is a 77.8% LTV. You've crossed the 80% threshold. At this point, you can contact your lender, pay for a new appraisal to prove the home's value, and formally request to have your PMI removed. That $240 per month is now back in your pocket. And if you do nothing, the law requires that lenders automatically terminate PMI when your loan balance is scheduled to reach 78% of the original home value. But relying on this can mean you overpay for years, especially if your property value has shot up. Being proactive is the key. So the down payment, LTV, and PMI are a tightly connected trio that dramatically influences not just the interest rate you see on NerdWallet, but the total monthly cost of your mortgage. A higher down payment lowers your LTV, which reduces the lender's risk, which gets you a better interest rate and helps you avoid PMI. It's a cascading effect of positive outcomes. When you are comparing those lender offers on the screen, remember that the rate is just one part of the equation. You have to look at the whole package. A lender might offer a slightly lower rate, but have stricter PMI requirements. Another might have a slightly higher rate but more flexible terms. It's about the total long-term cost. We've now covered your personal financial health, your credit score, and your debt-to-income ratio. And we've just dissected the structure of the deal itself, your down payment and loan-to-value. These are the factors that are mostly within your control. But there's another major piece of the puzzle that has less to do with you and more to do with the actual asset the bank is lending against. We need to talk about the property itself. The type of home you buy and even its intended use can swing your mortgage rate in ways you might never expect. Let's start with one of the most fundamental questions a lender will ask you. A question that seems simple on the surface but carries immense weight. What are you going to use this property for? Is it your primary residence, a second home, or an investment property? Your answer to this single question can cause a wider swing in your interest rate than a 100-point difference in your credit score. Think about it from the bank's perspective. Their biggest fear is you defaulting on the loan. So they ask themselves, under what circumstances is this person most likely to stop paying? The data over millions and millions of loans is crystal clear. People will fight to the absolute bitter end to keep the roof over their own head. They will sell their car, they will eat ramen noodles for a year. They will do whatever it takes to avoid foreclosure on their primary residence. This makes a loan for a primary home the lowest possible risk for a lender. It's their gold standard. And because it's the lowest risk, it gets the absolute best interest rates. Now let's change one variable. You tell the lender, this is a second home, a vacation cabin up in the mountains. Suddenly the risk profile changes. It's no longer a fundamental need, it's a luxury. If you hit a rough financial patch, you lose your job, face a medical emergency. What's the first major expense you're likely to cut? It's probably not the home your family lives in day to day. It's the vacation cabin. Lenders know this. They know that a second home is the first major asset people are willing to let go of when times get tough. Because of that slightly elevated risk, the interest rate for a second home will almost always be a little bit higher than for a primary residence. Maybe an eighth or a quarter of a percentage point. Not a deal breaker, but a noticeable difference. But the real jump, the one that gives people sticker shock, happens when you check the box for investment property. This is a property you intend to rent out to someone else. From the bank's point of view, this isn't a home. It's a business. And you, the borrower, are a business operator. This changes the entire psychological equation. Your decision to pay the mortgage is no longer emotional, it's mathematical. If the rent doesn't cover the mortgage, if you can't find a tenant for 6 months, if the property value drops and you're suddenly underwater, a purely rational investor might make the calculated decision to just walk away and cut their losses. It's a strategic default. The emotional attachment isn't there. Because this risk of a strategic default is so much higher, lenders price it accordingly. It is not uncommon for an investment property loan to have an interest rate that is a half point, 3/4 of a point, or even a full percentage point higher than a loan for an identical primary residence. So when you're on NerdWallet and you toggle that little drop down from primary to investment, don't be shocked when all the numbers on the screen get significantly worse. It's a direct reflection of the bank's perceived risk in your intended use of their money. Beyond how you use it, the physical type of property matters immensely. The classic single-family detached home is the vanilla ice cream of real estate. It's simple, lenders understand it, and it generally carries the least amount of complication. This is the baseline against which all other property types are measured. Now, what if you're buying a condominium? To a lender, a condo introduces a whole new layer of shared risk. You could be the most responsible borrower in the world, but your property's value is tied to the financial health of the entire building and the competence of the homeowners association, or HOA. What if the HOA is being sued? What if they haven't been collecting enough dues to properly maintain the roof or the elevators? What if a large percentage of the units in the building are rentals, not owner-occupied? Which statistics show can lead to higher rates of deferred maintenance? A lender has to investigate all of this. They'll often do a condo review to assess the health of the HOA's budget, their insurance coverage, and the owner-occupancy ratio. If the condo project doesn't meet their specific criteria, they might not lend on it at all. And even if it does, the added complexity and shared risk can sometimes result in a slightly higher interest rate compared to a single-family home. The same logic applies, but even more so, to multifamily properties like a duplex, triplex, or fourplex. Even if you plan to live in one unit and rent out the others, a strategy known as house hacking, the lender still sees it as a hybrid residential commercial property. They are now underwriting your ability to be a landlord. They have to account for the risk of vacancies, the potential for non-paying tenants, and the increased costs of maintenance for multiple units. This added risk and complexity means the rates for multifamily homes are typically higher than for a single-family home. Then you have more unique property types like manufactured homes. A manufactured home, especially one on leased land, is often treated more like a vehicle than real estate. It can depreciate in value, which is the opposite of what lenders want to see in an asset securing their loan. As a result, financing can be more difficult to secure and often comes with significantly higher interest rates. Finally, and this ties everything together, we have to talk about the property's value in relation to the loan amount. This is called the loan-to-value ratio, or LTV. We've talked about your down payment from the perspective of what you can afford, but let's look at it from the bank side. Imagine two scenarios. In scenario 1, you buy a $500,000 house with 5% down, which is $25,000. Your loan is $475,000. Your LTV is 95%. You have very little skin in the game. If the market takes a slight dip of just 6%, you're immediately underwater, meaning you owe more than the house is worth. This makes it much more tempting to walk away if you run into trouble. In scenario 2, you buy that same $500,000 house, but you put 25% down, which is $125,000. Your loan is $375,000. Your LTV is 75%. You have a massive equity cushion. The market would have to crash by more than 25% before you'd be underwater. The bank looks at this and breathes a huge sigh of relief. Why? Because if you default, they are in a much safer position. They can sell the property even at a discount and still be virtually guaranteed to get all of their $375,000 back. That lower risk for them translates directly into a lower interest rate for you. The lower your LTV, the more favorable your rate will be. This is why you often see tiered improvements in rates as you cross certain LTV thresholds like 90%, 80%, and especially 75%. Having more equity doesn't just help you avoid private mortgage insurance. It can actively lower the base interest rate the lender offers you. So you see, the mortgage rate isn't just a reflection of you, the borrower. It's a complex, multifaceted assessment of risk. Your finances are one half of the equation, but the property itself, what it is, where it is, and what you plan to do with it, is the other equally important half. It's the tangible asset that backs the entire deal. Now, with all these factors in mind, your personal finances and the property's profile, we can finally look at the last piece of the puzzle: the vast external forces of the economy itself. This is where your personal financial story meets the global economic narrative. You can have a perfect credit score, zero debt, and a massive down payment, but if the wider economy is in turmoil, your mortgage rate will reflect that. You don't exist in a vacuum, and neither does your loan. The first and most powerful player on this stage is the Federal Reserve. You hear about them on the news all the time, talking about raising rates or cutting rates. But here's a crucial distinction. The Fed does not directly set mortgage rates. They don't sit in a room and decide you'll pay 6% on your 30-year fixed. What they do control is the federal funds rate. This is the interest rate at which banks lend money to each other overnight. Think of it as the wholesale cost of money for the banks themselves. When the Fed raises this rate, it becomes more expensive for your lender to borrow money. And just like a grocery store raising the price of milk when their cost from the dairy farm goes up, lenders pass that increased cost on to you, the consumer, in the form of higher interest rates on everything, including mortgages. It's a ripple effect, starting with the Fed and eventually reaching your front door. But there's an even more direct indicator that mortgage lenders watch like a hawk: the 10-year Treasury yield. This might sound technical, but the concept is simple. A 10-year Treasury note is basically a loan you give to the US government. It's considered one of the safest investments on the planet. Mortgage rates and the yield on this Treasury note tend to move in lockstep. They're like dance partners. When one goes up, the other almost always follows. Why? Because global investors are constantly choosing where to put their money. If they can get a safe, guaranteed return from a Treasury note, The investments that compete with it, like bundles of mortgages known as mortgage-backed securities, have to offer a more attractive return to lure that money away. To make those securities more attractive, the interest rates on the individual mortgages within them have to go up. So, if you ever want a sneak peek at where mortgage rates might be heading tomorrow, look at what the 10-year Treasury yield is doing today. It's the closest thing we have to a crystal ball. Then there's the big one, the factor that affects every dollar you spend, inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. For a lender, inflation is the enemy. Imagine they lend you $300,000 at a 4% interest rate. If inflation for that year is running at 6%, the money they get back from you in payments is actually worth less than the money they lent out. In real terms, they are losing money on the deal. To protect themselves against this future loss of value, lenders charge higher interest rates during periods of high inflation. They bake the expectation of future inflation into the rate they offer you today. It's their shield against the eroding power of a devaluing dollar. And of course, the overall health of the U.S. economy plays a massive role. When the economy is booming and unemployment is low, people are confident. They're getting raises, they're secure in their jobs, and they're more likely to go out and buy a house. This high demand for homes creates high demand for mortgages, which can push interest rates up. Conversely, during a recession, when unemployment is high and people are scared, demand for housing plummets. To entice the few people who are still willing and able to buy, lenders often have to lower rates to make borrowing more attractive. It's the timeless law of supply and demand playing out in the biggest market of all. So, where does NerdWallet fit into this giant, complicated picture? This is the most important part to understand. NerdWallet is not a bank. It is not a lender. NerdWallet does not set or control any of these rates. NerdWallet is a marketplace. It's a financial compass. Its job is to stand in the middle of this chaotic intersection where your personal finances, your chosen property, and these massive economic forces all collide. It takes your information, your credit score, your income, your desired loan, and it queries a vast network of actual lenders in real time. Each of those lenders is looking at the same broad economic data. They all see what the Fed is doing, what the Treasury yields are, and what the inflation rate is. But each lender has its own unique business model, its own appetite for risk, and its own profit margin they need to hit. One lender might be trying to aggressively grow its market share in your state, so they might offer a slightly lower rate to win your business. Another might specialize in FHA loans and have a more streamlined, cost-effective process for them, allowing them to offer a better deal. A third lender might be more conservative and price their loans slightly higher to account for potential risk. This is why you can input the exact same information and see a range of different rates on NerdWallet. The platform's incredible value isn't in creating the rates, it's in providing transparency. It pulls back the curtain and shows you how these different lenders are interpreting the exact same set of facts, your facts, and the economy's facts. Without a tool like this, you'd have to call dozens of banks one by one, submitting application after application, trying to compare apples to oranges. NerdWallet lays it all out on one screen, turning a process that used to take weeks of painstaking effort into a few minutes of clicking. So let's bring it all home. We started this journey with a single number on a website, a mortgage rate. And we've discovered that this number isn't just a number. It is the final, condensed answer to a profoundly complex equation. It's an equation with deeply personal variables that only you can control. Your history of financial discipline, reflected in your credit score, your earning and spending habits, captured by your debt-to-income ratio, and your long-term savings, represented by your down payment. It's an equation with tangible, physical variables: the location, type, and value of the home you want to buy, and how you intend to use it. And finally, it's an equation with vast, impersonal variables that are far beyond your control: the monetary policy of the Federal Reserve, the behavior of global bond markets, the persistent pressure of inflation, and the overall health of the national economy. You cannot call up the Fed and ask them to lower rates for you. You can't single-handedly change the 10-year Treasury yield. But you are not powerless. The entire purpose of understanding this complex system is to realize where your power truly lies. Your power is in focusing relentlessly on the variables you can control. You can build your credit. You can increase your income. You can pay down your debt. You can save more for a down payment. By strengthening every single personal factor in your half of the equation, you make yourself the most attractive, least risky borrower possible. You position yourself to get the absolute best rate that the market in its current state is willing to offer. The rate you see on NerdWallet is the meeting point between your personal preparation and the economic reality of the day. Your job is to make your side of that meeting as strong as humanly possible. The mortgage is the largest financial commitment most people will ever make, but it doesn't have to be the most mysterious. The key to unlocking a house isn't just about getting a loan. It's about understanding the forces that shape it. It's about knowledge. And now you have it. You know what the banks know. You see the full picture. Go build your future.